Good day, fellow investors. Last week we discussed how the situation in Europe will see more inflation, they need to lower rates, and how it's better to invest globally. And there were many comments on how to do that, and that's what I want to explain in this video, how I have been investing from Europe for the last 20 years and how I plan to continue investing from Europe. Of course, I live here, but where are the opportunities and what to avoid? And then also this question was whether on my research platform I offer such a service from a macro perspective, and I want to invert that. I look from a micro bottom-up perspective so that whatever happens with the macro, which is, let's say, long-term weakness economically, we'll see with inflation, and how to invest so that we do better than that to, let's say, accumulate real wealth. That's the focus of what I do. You can check my research platform or simply subscribe here to YouTube for that kind of mindset. And let's look at the situation, the outlook, the taxes you are paying, and the indirect taxes that you are paying but you don't know you're paying through inflation. And then also the investing strategy. If we look at the situation with Europe, well, the current situation is, let's say, good, but the fundamentals, the long-term fundamentals are a little bit shaky. Life is okay, right? We live in Europe, it's a great place to live, I like it, and the thing is that the quality of our lives is based on a rigged market interest rate and on piling debts. That can last until it can't. And then you say, okay, but European deficits are not that bad, so we are there in the range 2-3% according to the EU regulative, so everyone is behaving okay now. It's much better than the 7% yearly deficits expected in the United States. So Europe is not the reserve currency on the world, so we cannot spend 7% of our gross domestic product extra, we can spend 3%. Still spending, I would say. And talking about interest rates, this is the Italian 10-year bond yield. The interest rate there is 3.38%, and Italians are already hurting. This was great for Italy, France, Portugal, Spain. So they could live with 1% on the 10-year Treasury, even a little bit lower. We went also to free money, but the 10-year Treasury of Italy is way cheaper than the 10-year Treasury of the United States in US dollars. So the clear message here is interest rates in Europe are rigged, so pushed to the lower maximum possible low to keep the economy up, to keep jobs, to keep spending, to keep investing, to keep the perceived situation as is. Nothing wrong, we are all people. The more the good continues, the more technology and everything should improve the quality of life. So, okay, we do the best what we can. ECB is printing money, helping Italy, helping Greece, whatever. Nothing wrong with that. It is just like that. The only problem is that with such lower interest rates, and they already said they will lower to find the new neutral that will likely be higher than the decade of zero rates, maybe 1% or something, just because we cannot survive with 4.5%, and that's why also the ECB started lowering rates before the Fed started. But there is always a cost to a rigged market. Whenever governments intervene into markets, there is someone who benefits and someone who pays. I already explained in that video how if 50% of my pension fund, this is Dutch pension fund, is invested in fixed income, I can say goodbye to 50% of my purchasing power in the future, because with zero interest rates or 1% or even 3% of Italy and 3-4% real inflation, I make nothing on that money. So 50% of your purchasing power in the future from your pension will evaporate because of low interest rates. On the other hand, yes, stocks go up because of low interest rates, so that part of the portfolio makes you feel richer if you already have stocks. If you're younger than 50 and you're still building a pension fund, then that part of the portfolio is also screwed for you. Perhaps this is best shown when purchasing a home. So prices in the Netherlands went up 2x of homes for those who wanted to buy. So if you're young, you need to pay 2x what was the price when I bought in November 2015. And the gross income didn't go up 2x in the same period. It actually went up only 1.25x. So the working class, those that do not have assets, are getting poorer from that perspective. If you look at Deutschland, real German inflation adjusted wage index 100 2007, we are now at 105. That's practically no growth for 2 decades. That's crazy. If you look at debts, those are increasing, and you might see here decreases, but as inflation was 8% here it was 6%, and now it's getting lower, then this national debt to GDP ratio is getting lower, but the debts are there. So the outlook is that interest rates will get lower, and that is also what the ECB is promising, because we all want this way of life to continue with lower interest rates, and therefore they expect to go even lower to stimulate the economy. Maybe settle around 2, but I think that if there is a recession, those will again settle to 0. They will try to print money, and as long as it works for the ECB, as long as we holders of those pension funds are happy to waste our pensions through inflations, as long as that holds, nothing is wrong. But if one day we say, oh wait, there will be inflation, the euro is getting weaker as they are lowering rates, then all that we buy globally gets up a little bit. So it is a delicate balance. I hope they can hold it for as long as possible. But once that balance is gone, we will see inflation, and then they cannot lower rates, and then we will start to have to pay the real price of what's being done. No problem with that. And you can see here, inflation, they say it will go lower, everything is okay, GDP will go higher, and they continue to work on that balance. However, what if the projections are not correct? What if we have a recession next year? Standard procedures, they will print more money, try to save, then there will be issues, interventions, etc., etc. But the long-term trend is for more inflation, no matter how you measure it. If real inflation comes, then one of the two certainties in life comes, and that is debt and taxes. Now we are taxed indirectionally through inflation, through lowering the purchasing power of the pension funds, to lowering the purchasing power of real wages for people that have just income. And you can see that by comparing to the Swiss franc, 1 euro was 1.55 Swiss francs. Now we are below 1 Swiss francs, and that is the inflation tax of 2%. That is there, but nobody tells you, and simply is necessary to keep the way we are living. So that will continue, nothing wrong with that. That's simply to compete. If you want to increase productivity, you need to learn more, you need to invest in education and all that, you need to work harder, more hours. That's something that most people don't want. Let's get real. The first solution is to already be rich. So if you're already rich, if you already have land, assets, buildings, low debt, or good debt with fixed long-term maturities, then you are already rich. Lower interest rates, inflation will help you and make you even richer. Nothing wrong with that. So a little bit ironically, but lower rates make rich people richer, working people poorer. That's how it goes. The second solution is to accumulate assets, as rich people do, that create value and have pricing powers. So that can be businesses, that can be houses with good structured deals, land, whatever feels like you know it, and whatever rich people have that keeps on being rich. Yes, you need to work harder if you are on wages. You need to invest on the side, not count on your pension fund, because we have seen it will not be great in the future. So you need to work twice as much if you're not already rich. Well, that's the unfortunate truth. We can own businesses. We have discussed how there is some businesses that are cheap now, like food. DHL, European business, will likely do good over time, perhaps to watch something when it comes to recessions, something buy it cheaper, avoid the expensive ones, even if those will do good already. Real estate, if you know what you are doing, if you can buy a duplex, rent something out. So everything requires more work, more investment, more income, more money. But yes, we have discussed globally there are good stocks. On my research platform you can find even better investments there, and that's the story here. It is all about building a portfolio, slowly putting brick by brick by brick. And when I make a video about Europe, there is always these comments, everyone wants immediate answers. There is no such thing. Oh, buy the dollar, do this. That's the way how to lose money. You have to find a mindset, a process. Every month I'm building and adding a brick, a brick, a brick, a brick. And so if we have higher inflation in 5 to 10 years, and inflation will go up and down like we have seen it 2 years ago, then you know that those bricks will provide the value you're looking for, the protection against inflation you're looking for. But it's a long-term process of bricks building, not a game of I change my portfolio here, I change my portfolio there. And there is always this question also on portfolios. So, and what should I do? What should I do? Do nothing. Start building these bricks on the side with the right mindset. And over time, this brick building will overshadow what you have now. If it's really over expensive, overvalued, you might rebalance a little bit. But I am against those crazy give me solutions now, because those ways of investing are the ways that, if you're in trouble now, led you to where you are now. Another option, if I look at the 30-year mortgage in Europe, if you can find a good deal, yes, that 4% fixed for 30 years, that's free money. That is still free money for the next 30 years in the Netherlands, for example, on real estate too, but you need to find and know what you are doing. Let's discuss the investing strategies. And as I said, don't gamble, build wealth, forget about urgency. Look for businesses that will grow cash flows, that will increase purchasing power, that will benefit from inflation. I don't know, we discussed Nutrien, Archer Daniel Midlands, things that have already built a lot of infrastructure, even Rubis, even if there is the French tax issue. So a lot of infrastructure cannot be replaced because it's already built. So that allows you for inflation protection, because it suddenly costs more and more to replace that. Think about things that will be there in a decade or two. You're going to eat, you're going to do this, you're going to do that. You don't know how much AI you will be using. And when it comes to investing in the investor life cycle, I'm always about building bricks, building bricks, building bricks, building bricks, so that you do well over time. That's the mindset I'm trying to share by video, and you can check here on the quadrant how we look at risk and reward, build for the future. I love Europe, I like the community, everything. It's a great place to live, peace and this and that. I hope this continues. There will always be issues. Don't think I'm that pessimistic that it will be a disaster. I really hope we are smarter than 75 years ago or 100 with the world wars. So that's something, digitalization, connectivity, I hope will be smarter, but there is this cost of inflation, and it's not about, oh, it's terrible or this. I always have a gray perspective on things. It's good, it's bad, it's good, it's bad. And then in the middle, I'm thinking, okay, how can I get advantage from that? That's all you need to do. With that mindset, over time, you will end up good. And don't forget to check my research platform in the link in the description below for my portfolios and to seeing how am I structured. You can do that for free, 21-day money back guarantee. Make an informed decision to see whether that can help you.